Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the accounting terms 3. Hope you will like, share and subscribe our video. Accounting terms 3, the third part of the series. Cash flow statement. As per IAS 1, financial statements are the basic and formal annual reports through which the corporate management requires for external reporting, that is owners and various other external parties, which includes investors, tax authorities, government, employees, and also for the internal needs of the management like planning, decision making and control. The financial statements generally includes two statements: balance sheet, which is prepared at the end of the accounting period, and statement of profit and loss account, which is prepared for the year end. Apart from this, there is also a need to know about the movement of funds and changes in the financial position of the company. For this purpose, a cash flow statement is prepared. As per IAS 7, the standard requires the presentation of information about the historical changes in an entity's cash and cash equivalents by means of a statement of cash flows. Information about the cash flows of an entity is useful in enabling users of financial statements to assess the ability of the entity to generate cash and cash equivalents and the needs of the entity to use those cash flow statements. Fund flow statement. A fund flow statement shows the inflow and outflow of funds during a given period of time. It displays sources of funds and application of funds. It is created to describe changes to the firm's working capital position and is also created to describe a shift in the financial position. Sources of funds. It talks about the extent of funds availed from owners and outsiders. Application of funds. It talks about how the funds have been utilized. Funds deployed in fixed assets and funds deployed in current assets. Closing the books and dividends. Closing the books. The informal phrase closing the books describes an accountant's finalization and approval of the bookkeeping data covering a particular accounting period. When an accountant closes the books, they endorse the relevant financial records. These records may then be used in official financial reports such as balance sheet and income statements. Dividends. In corporate accounting, dividends represents portions of the company's profits voluntarily paid out to investors. Investors are often paid in cash but may also be issued stock, real property or liquidation proceeds. In most cases, dividends follow a regularly monthly, quarterly or annual payment schedule. However, they can also be offered as an exceptional one-time bonuses. Accruals and fixed cost. Accruals, it means recording an expense that was incurred in one accounting period but not paid until a future accounting period. Revenues and expenses recognized by a company but not yet recognized in their accounts are known as accruals. Abbreviation is ACCR. By definition, accruals occurs before an exchange of money resolves the transaction. Accounts payables and accounts receivables are of this type. Fixed cost. A fixed cost or a fixed expense is a cost that stays the same regardless of increase or decrease in a company's output or revenues. For example, rents, employee salaries, insurance, loan payments, property taxes, etc. Variable cost and OD facility. Variable cost. Variable costs change as output or revenues change, and manufacturer would incur higher costs if it doubles its product output. For example, raw materials, overtime, transport, commissions, higher tax rates, etc. Overdraft or OD facility. Bank provides an overdraft facility to those organizations who have a good credibility in the market, which means lets the entity borrow money through your current account by taking out more money than you have in the account. In other words, you will go overdrawn. There is usually a charges for this, and this is for a limited period of time. Auditing. Audit is the examination or inspection of various books of accounts by an auditor, whether it is an internal auditor or external auditor, to detect and prevent frauds and errors. Definition. Auditing is concerned with the verification of accounting data, determining the accuracy and reliability of accounting statements and reports. Types of audit procedures. Performing analytical procedures, which is basic yet most powerful tool. Confirmations, inquiry, inspecting assets, inspecting records or documents, observations, recalculation and reperformance. That's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel Accounts and Finance with FAR SK. Thank you. Have a great day.